Hey everyone, welcome back to the channel. This is your weekly review for July 27th through 31st. Quick reminder before we start. This is educational. It's how I read the market with a Conflux method. Not a signal service and not financial advice. Trading futures and options carries real risk, so take this as a walkthrough of my thinking. Let's get into it. First, a look back at last week, then the week ahead. Let's start as usual with last week. Last week, I mostly traded gold. There were a couple of good chances to get into the market. First, we rode the longs, and toward the end of the week, we got into shorts nicely. So the week wasn't very active, but it was still a good one. This week, I've tried to break down more assets. Now let's turn to the week ahead, and before the individual instruments, let's set the bigger picture, because everything this week hangs off it. The next 2 weeks are the key ones, because of the Fed, the Bank of England, and the Bank of Japan meetings, and the NFP that follows. The main market driver is the dynamics of the US 10-year yield. If yields keep rising, the dollar stays strong and risk assets stay under pressure. At the first signs of a reversal in the yields, I'd expect a large correction in the dollar and a recovery across most markets. On the fundamentals, an intervention next week looks highly likely. So let's start with what's driving all of it right now, the dollar. 103.90 is visually the ceiling on the dollar index for now, but the main debt is at 106.50. Everything will depend on Warsh and Basant for the dollar's direction. The treasuries and their actions are the foundation for next week. The key scenario is a continued rise in the 10-year yield toward the important resistances, which supports the dollar strengthening into the 100, 2.72, 104 area. A vertical rise to 106.50 is very unlikely, because on the 10-year, that's the 5.75 to 6% region, and that's already a financial crisis level for the whole world. The Fed would need to hike 0.5% on Wednesday, and then after a spike up in the dollar, everything would go into a correction. The 10-year too. But I strongly doubt they'll even hike 25 basis points. More likely they wait until September, and that kind of waiting could drag the 10-year towards 6%, which is a dollar at 106.50, and the euro around 1.0985 on spot. If the crisis scenario develops further, DXY could go all the way to 106 to 108. After the Fed or the US Treasury steps in, I'd expect the yields to reverse and the dollar to weaken. And since the dollar is tied directly to the 10-year yield, let's stay there for a moment. The upper zones are very bad for the entire financial system. Powell was rattled all through his years as chairman, whenever it approached 4.8 to 5%, and now 6% is already looming. I'm not a panicker, and I don't like looking that far ahead. But if that happens, if we get to 6%, then the S&P 500 and the whole US stock market fall vertically, and risk assets get driven down almost straight. But that's just it. For now, these are only thoughts. I don't really want to trade a crisis. With that backdrop set, let's move to the instruments, and we'll start with the euro. The zones have narrowed and landed exactly where they should. Wednesday's volatility is being actively traded on the options. There's a 1-point zone at 1.1380, and from there it can ride to the straddle and the puts. Those are the biggest openings, so 100 points is an easy ride. I'll be up and working from the open. I'll also work 1.1411 for now. Ideally a 200-point drop for buys, because the US with its treasuries should start scrambling, and that's weakness for the dollar. On Friday, there were also a lot of options openings around 1.1275 to 1.1285, where you can work a pullback with a reduced lot. The bigger picture, I expect the current decline to finish and a reversal to form, with a buy interest around 1.1185. The medium-term recovery target is the 1.1560 to 1.1735 area if things stabilize after the Fed. So the idea is, first the decline, then the correction up. Now from the euro, let's move to the yen, which for me is the standout this week. This is the main trade idea for the coming weeks. I expect this move from the Bank of Japan, a final impulse up to 166.75 to 167, then the intervention and a strong reversal toward 158 to 159. The main position is planned from that zone, counting on a fast strengthening of the yen after the central bank meetings. From the 63 strike, the options go in the money. I'll trade it, and then we'll see what they paint until August 12th. Now, to the pound, which ties in closely with what the euro does. If the euro heads to 1.1185, then the pound needs to spill to 1.2919. Given that the Bank of England is on Thursday, and like the ECB, won't hike and will leave it unchanged, the odds of a drop to 1.2919 are reduced, but they still exist. Working 1.3427 is also necessary for the pound, since that's the main debt at the moment. And since it started falling earlier than the euro, it can pull back earlier too. There are also players in here with options on the zone below. The pound looks weaker than the euro, but is also near a potential reversal zone. So the main interest is buys from 1.3244, with a first target around 1.3427 and a further target of 1.3758. If the market plays out the crisis scenario, the decline could go deeper before a full recovery. For now, I'm working the nearest zones, and I'll decide on the rest by Wednesday. Let's switch from FX over to the indices and to the S&P 500. Until Thursday's clearing, these options are interesting if the S&P spills. That's also the week's maximum volatility. So let's see whether they give such a spill. Rising yields keep the pressure on the US stock market. So for now, I prefer selling into strength and buying only from predefined strong support zones. If the full crisis scenario plays out, the index could correct deeply, significantly below current levels. Now let's move over to the metals, and let's start with silver. For now, I'm looking at further downside. The main interest is sells after a confirmed break, then a buyback around 49.5. Silver stays a more volatile instrument than gold, so I'd expect a stronger move if the crisis scenario develops. And from silver, we move to gold, the one I traded most last week. The 10% zone for Monday is still alive, but I have big doubts they open with a rise. I like selling to the lower zones more. Given that Tuesday is the semi-annual expiration, Wednesday will bring a refinement of the zones. There's a very high probability that the contract's maximum volatility moves to 3,562 on Wednesday, but we'll see what the CME calculates after the expiration. All the money sits in these options, so don't forget the option of a spill down to 3,562, and 6% on the Treasuries hints that they could go there. The biggest buy interest is the 3,550 to 3,560 area, where I expect a major medium-term bottom to form. After that, the dollar goes into weakness and everything else into growth through the end of the year, and gold gets to 4,530 to 4,540 easily. Until that zone is reached, I prefer looking for sells. From the resistances, that's the plan for the week. Remember, these are zones and scenarios I'm watching. The market decides, not me. So let price come to your levels and let the confirmations line up before you act. If this breakdown was useful, subscribe and turn on notifications so you don't miss the next weekly review, and drop a comment with the instrument you want me to cover. And one more time, so we're clear. None of this is financial advice. I don't sell signals and I don't promise profits. This is educational content about the Conflux method, and everything here is my own view of the market. Trading futures and options involves a substantial risk of loss, so never risk money you can't afford to lose, and always do your own analysis. Take care, manage your risk, and I'll see you in the next one.